Hello, this is Dr. Karen Nunez, and today we're going to be talking about the Chapter 14 lecture, Financial Statement Analysis. Let's get started. So, financial statements are distributed to external users, internal users, to a wide range of users, and each group tries to cull valuable information from financial statements. And typically, they're looking at three dimensions. They're looking at liquidity, solvency, and profitability. Let's talk about these three things. So, liquidity is it measures a company's ability to convert assets into cash. That's what liquidity is. Solvency, on the other hand, looks at a company's ability to make their interest payments and to pay their debts. And then finally, profitability looks at a company's ability to generate earnings or profits. So, what we're going to look at in chapter 14 are techniques for analyzing financial statements so that we can gain a better understanding of liquidity, solvency, and profitability. There are two techniques that we look at this level for analyzing financial statements. One, we look at analytical methods. That means we'll examine changes in the amounts and percentages of the line items in financial statements across periods of time. And then we'll also look at ratios. Ratios just express financial statement line items as a percentage of another financial statement line item so that we can somehow gauge the relationships and the importance. Let's start with the analytical methods. There are typically three analytical methods, three commonly used analytical methods, and we'll look at two of them: horizontal analysis, vertical analysis, and common-sized statements. So horizontal analysis is the first thing we look at. Horizontal analysis means that we're going to compare financial statements across time. So we want to be able to measure increases or decreases. We want to know two things about them. We want to know about the actual amount, the absolute amount, and we want to know about the percent, convert those amounts to percentages. And that will help us understand changes and patterns. So this is an example of horizontal analysis. Again, it's called horizontal analysis because we're measuring uh, increases and decreases across time. In this case, we're looking at two time periods, year 5 and year 6. So we're measuring increases and decreases across this period of time. And we are looking at the amount of increase or decrease and the percent of increase or decrease over time. So let's focus first on current assets. When you look at current assets, you can see in year 5, they had $533,000 in current assets. But in year 6, that changed. It went from $533,000 to $550,000. So again, we want to measure the change over time. So the change here, the amount of the increase, well, the difference between 550 and 530 is an increase of 17,000. And that 17,000 represents a 3.2% increase over time. That's just the 17,000 divided by the base year, the first year, 533,000. That's how we get that 3.2%. And we could do that for every line item on this balance sheet. Measure the change over time in the dollar amount and in the percentage amount. And we can do it for not just the balance sheet, but we could do it for other schedules as well. Like in this case, just current assets, right? Or we could do it for the income statement, right? If we want to look at sales from year 5 to year 6, well, in year 5, the sales were 1.2 million. In year 6, the sales were bumped up to 1,498,000. That's a $298,000 increase. That's the amount of the increase. And that $298 represents a 24.8% increase. Again, that's 298 divided by what we call the base year, the first year, 1.2 million. So we could do it for the balance sheet, the income statement, We can do it for the statement of retained earnings, right? We're just looking at changes in numbers over time. And that's what a horizontal analysis does. We're looking at numbers across time. Now, vertical analysis is a little bit different. Vertical analysis means that we look within a statement and we want to measure um, each line item as a percent of some base amount on that statement. So, for example, if we're looking at the balance sheet, that we want to, then we want to know what each line item is as a percent of total assets. Uh, if we're looking at the income statement, we want to know what each line item is as a percent of sales. We use some base amount and express each line item as a percent of the base amount. So, for example, if we're looking at the balance sheet, the base amount is always going to be sales. I'm sorry, if we're looking at the balance sheet, the base amount is always going to be total assets. So every line item we are expressing as a percent of total assets. So for example, current assets at 550,000 are 48.3% of total assets. How do we get that? It's 550 divided by 1,139,500. And same thing with long-term investments. They're 8.3% of total assets. It's the 95,000 divided by the 1,139,500. So everything is expressed as a percent of those total assets. Everything on this balance sheet. And we could do the same thing on the income statement as well. So a vertical analysis, again, we're measuring vertically, right? We're measuring every line item on this income statement as a percent of some base amount. The base amount of sales, everything here is expressed as a percent of sales. So for example, the cost of goods sold of 1,043,000, we want to divide into that the sales of 1,498. So we're expressing cost of goods sold as a percent of sales. Cost of goods sold was 69.6% of sales. Gross profit, that 455, right? We want to divide the 1.498 into that 455. Well, that's 30.4%. Everything is expressed as a percent of sales. Now, so those are the analysis tools that we use in this chapter, the horizontal analysis and the vertical analysis. But we also look at ratios, a few ratios, not all of the ratios, because there are a lot of them. We're just going to look at a few ratios. So if we want to measure liquidity, we look at current position. And we can do that with the two ratios that we're going to do that with in this chapter are the current ratio and the quick ratio. We can also look at liquidity by looking at the accounts receivable and by looking at the inventory. Those will provide us key indicators about our ability to collect on receivables and our ability to sell our inventory. So current position, again, tells us about the ability to pay those current liabilities. It tells us about liquidity. And there are a few key ratios that we will measure in this chapter. And again, one of the most important ratios that we see is the current ratio. It measures current assets to current liabilities. So it's a ratio that tells us how much we have in terms of liabilities and assets. So in this case, in year 6, when we take the current assets and divide the current liabilities into the assets, we end up with a ratio of 2.6. What does that tell us? It tells us for every dollar we have in current liabilities, we have $2.6 in current assets. In year 5, for every dollar we had in current liabilities, we only had $2.2 in current assets. So there's actually some improvement in our current ratio, in our ability to meet those current liabilities. And it's actually a very commonly used indicator and a very reliable indicator. In addition to the current ratio, we will also look sometimes at the quick ratio. The quick ratio, what it measures is the ability to use those quick assets to pay those current liabilities. What are the quick assets? Well, the quick assets considers only assets that can be quickly converted into cash. And that would be cash, temporary investments, accounts receivable. Typically, it would take longer to convert inventories. So we leave off inventories and prepaids. Those typically aren't assets that can be quickly converted into cash. So when we talk about the quick ratio, we only want to measure the quick assets. as a ratio to the current liabilities. So the quick ratio, in this case, the quick assets over the quick liabilities. And again, it's those current assets that exclude things like inventories and prepaid assets. So when we measure the quick ratio here, you can see just those quick assets over the quick liabilities. Well, for every dollar we have in current liabilities, we have $1.3 in current liabilities and in current assets. And in year 5, or for Jefferson, for every dollar we have in current liabilities, we have less than $1 in quick assets. So obviously Jefferson would have great difficulty trying to pay their current liabilities with quick assets. In fact, they don't have enough quick assets to pay their current liabilities. Lincoln, on the other hand, does have enough quick assets to pay their current liabilities. And in addition to looking at the current ratio and the quick ratio, when we want to measure liquidity, we always look closely at accounts receivable and inventory. And there are two key ratios that we use: the turnover ratio, accounts receivable turnover, and the days sales in receivables. It tells us how quickly we can collect on those receivables. So in this case, the turnover ratio measures sales to receivables. Sales over average accounts receivable, and average is typically just beginning plus ending divided by 2. So in this case, when we measure our accounts receivable turnover, it tells us that we're able to turn over or collect on those receivables 12.7 times a year, right? Given the average balance in receivables and given our sales, right? Sales divided by average accounts receivable, we're able to collect on those receivables 12.7 times a year. Now, I usually find that the more useful measure and the more reliable measure is the days sales in receivables measure. So we're really kind of converting that turnover into a days measure. So we take the average accounts receivable and we divide it by sales, by the average sales. Average sales is just sales divided by 365 days. So in this case, what it tells us is it it actually takes us 28.6 days to collect on our receivables, right? So when we make a sale on account, right, when we extend credit to our customers, it takes them on average 28.6 days to pay. That's what that measure tells us. And that's important, because if we have credit terms that, for example, are net 15 days, we expect our customers to pay in 15 days, but they're paying, in this case, 28.6 days. So it's a very useful, very reliable, very simplistic measure to use in helping us understand the ability to collect on those receivables. And in this case, you can see in year 5, it was taking us 39.5 days to collect on receivables. That actually has improved from 39.5 to only 28.6 days to collect on those receivables. So the receivables measures are really very useful, very telling. And then the second measure that we look at in terms of analyzing our liquidity is inventory. We look at our ability to sell that inventory, because the extent to which we can sell it means that we're able to convert that into a receivable and then collect the cash. So in this case, we look at two measures: the inventory turnover, how many times we sell through our inventory, and how long it takes us to do that in days. So the turnover measure is cost of goods sold over average inventory. Average inventory, again, is just the beginning plus ending divided by 2. So in this case, if we take that cost of goods sold and divide it by the average inventory, this tells us on average, this company turns over or sells their inventory 3.8 times a year. That's how many times they clear out that inventory, sell it through, and then rebuild it or replenish it 3.8 times a year. And again, I like to look at days. I like to know how long that takes. So that's what the days sales tells us, right? We're really kind of converting that measure to days. Take the average inventory and divide it by the daily cost of goods sold. Cost of goods sold divided by 365 is daily cost of goods sold. So what that tells us in this case is, right, that again, cost of goods sold, average cost of goods sold divided into the average inventory tells us that for this company, right, it takes them 95.7 days to sell their inventory. right? So when they put something in inventory, that's how long it takes them to unload that inventory or find someone to sell it to, 95.7 days. But that's actually an improvement. In year five, it took them 132.2 days to kind of turn over or sell that inventory. And year six, it's down to 95.7. So those are key measures to help us understand position or liquidity. Next, let's look a little bit at solvency, the ability to meet those maturing obligations, those long-term obligations. And typically those are long-term debt obligations, creditors that have lent money either in bonds or other types of long-term debt. So a couple of ratios that we will look at, this first one, the ratio of fixed assets to long-term liabilities and the ratio of liabilities to stockholders' equity. We won't look at the times interest earned in this chapter. So the first measure, the ratio of assets to liabilities. And that's important because creditors want to know how much debt you have and how your investment in assets compares to your outstanding debt. So for this company, right, that ratio is 4.4. For every dollar they have in long-term debt, they have $4.4 in fixed assets. And obviously more is better. The more assets you have relative to your debt is always better. More is always better. And you can see the improvement here from year five to year six, from 2.4 to 4.4. But again, all we're doing is measuring the ratio of assets to debt. Just divide the debt to the assets, and we've got this ratio of 4.4. The other measure is the ratio of liabilities to stockholders' equity. Right, for every dollar we have in equity, how much do we have in debt? So you can see the ratio of investment in stock versus the investment in debt. So you can see here we got 829.5 in equity and only 310 in our liabilities. That's a 0.4 ratio. And obviously less is better, right? We would want less. I want to minimize that debt, maximize the investment in equity. And you can see that's actually shrinking as we go from year five to year six. And then the last category that we have here is the profitability, analyzing profitability so that we have some understanding of the company's ability to generate earnings, future earnings or future profits. And there's several ratios that we can look at here. But obviously, we don't have time to look at all of them, but key ones that we will look at are the asset turnover and the return on assets. So the first measure is asset turnover, the ability to use those assets to generate sales. That's essentially what that measures, the ability to use the investment in assets to generate sales. You know, for every dollar we have in assets, how much are we generating in sales dollars? That's what it tells us. And we really are focusing on those operating assets. That's really what we want to focus on. Assets that we use to run the business or operate the business. That's what should be in this denominator, those operating assets, not investment assets, not those assets that are non-operating or assets that are not used to run the business. Those are not assets we want in this denominator. So when we look at this measure, this asset turnover, again, we're looking at the ability to use those assets to generate sales. That's how we want to measure it. Those total assets divided by those total assets divided into our sales. So we end up here with a measure of 1.4, which tells us for every dollar we have invested, we get $1.04 in sales. That's the ability to turn those assets into sales. And that actually shows some improvement versus year five. We went from a 1.2 to a 1.4. So obviously more is better here as well. And the return on total assets looks at our ability to use those assets to generate income, income after interest. So we want to not income after we've added back that interest. So in this example, you can see if we take that income and we add back the interest, right? This is the income, add back the interest because interest is a non-operating item. So we really want to know what the income is that's being generated by the business. So we add back the interest to get that measure, and then we divide those assets into that. And what this tells us is, on average, you know, given our investment, our investment in assets, we're able to generate roughly 8.2% return on the dollar. Given a dollar investment, we get 8.2% of income or earnings or profits. And again, that's a sign of improvement. We've gone from 7.3% to 8.2%. And again, shows our ability to generate those profits. And then the last measure, we can also look at the ability to use those operating assets, just the operating assets, to generate just operating income. And same kind of thing. More is always better, right? Want to be able to generate as much income as we can. Putting it all together, there's a summary of the ratios in the chapter that you might want to have handy when you're working on the homework assignment, and also when you're working on the quiz for chapter 14, because you'll need to be able to calculate these ratios. And again, we're not using all the ratios, but the ones that you need are easily summarized on these schedules that are in the chapter, and you want to keep them handy for your calculations. So I'll see you in the problem session for chapter 14 in the next recording.